Hey there, everybody, and happy Monday. Welcome to Yahoo Finance Live. I'm Dave Briggs, along with Shauna Smith. Let's get you up to speed quickly on the market action on this Monday. Sounds like everybody kind of holding their breath, waiting for Mr. Powell to talk to Congress. And really, markets not doing much, kind of hovering around the level or flat level, if you will. Really, let's just say no movement whatsoever, Shauna. Can we just go with that?
Yeah, I think everyone's a little bit nervous. Maybe you're just on the sidelines, maybe the better way to put it here, ahead of what is going to be a very big week.
Case of the Mondays.
Case of the Mondays. At least we're in the positive territory, although just barely. We'll see whether or not we can hold on to those gains in the final 60 minutes. Let's also talk about another big story, and that is shares of Apple. Goldman Sachs initiating coverage on the tech giant with a buy rating from a new analyst here. We're going to tell you what he likes about this stock, and you're looking at gains of just about 2% with Apple.
All right, but first let's get you up to speed on what is happening with the market, and in particular Snap. Shares are popping in part on the growing effort to ban rival TikTok. Jared Blickery here to break down the charts for us. Jared, not much market action to speak of, but this is probably the biggest story that we've seen.
Yeah, one of the bigger ones. I think, is TikTok going to be banned outright in the U.S.? It seems unlikely now, but it's picking up steam. So who would want to be one of the main beneficiaries? The obvious answer is Snap. So we see that stock up 12% today, and that is a big movement for a stock. But when you consider its overall volatility and where it's come from, maybe a different matter. Now, I also want to point out where we had some activity right on the open there was right around the 200-day moving average, not shown here on a 2-day chart. But nevertheless, when we clear some of these technical indicators right here at these technical levels, a lot of times there's just a short covering rally. Now, let me show you a longer term chart of this stock here. And you can see it's really been consolidating for about the last 6 months. And when you take a look at the last 3 years, then you really get a sense of where this stock has been and where it is now. So we have gotten a little bit of liftoff from very, very depressed levels, but let's not get too excited just yet because there's a lot of work to do to get back up to these highs, much less anything else. Now, we're also taking a look at Hertz, kind of in the same camp that I would say more technicals going on here probably than fundamentals, but even with Hertz, there is really not a fundamental story the way I was seeing with Snap. Over the last 3 years, this is another stock that got a nice push up some time ago after it emerged from bankruptcy, by the way. This doesn't even show the full 3 years. After it emerged from bankruptcy, it has now sunk to lower levels. And I just want to show a 3-month chart of Hertz versus Snap. And you're going to see a similarity here. So we can see we have this run up into about mid-February, and then we have this little handle, almost like a cup and handle situation here. Am I going to get excited about it? Not just yet, and I'll explain why. But you can see this chart for Snap pretty similar. Why am I not getting too excited just yet? And that's because we are simply still camped out in the bottom end of this range. And you want to see a stock which I can get a little bit more excited about. That's going to be C3AI. Now here's a 1-year chart of that stock, and you can see it is busted to levels that exceed these current highs. And also I would mention the 200-day moving average that is trending upwards. So a few different stocks here, a few different looks. The chart formations may look very similar, but under the hood there's a little bit more going on, guys.
Yeah, C3AI, one of the beneficiaries of all this recent hype around AI. Jared Blickery, thanks so much. Well, it is a busy week ahead with Fed Chair Jerome Powell's testimony before Congress kicking off tomorrow. Then we've also got the jobs report on Friday. Investors will be parsing through the comments from Powell and also the data on Friday, trying to figure out what all of this means for Fed policy. We want to bring in Omar Aguilar. He's the CEO and CIO of Schwab Asset Management. Omar, it's great to see you again here. So the 10-year yield breaking above a 4% level last week, trending just to the upside, just below that level this week. How does the recent move in the bond market and also pairing that with what we've seen in equities, how that sets us up for what is going to be a very busy week?
Yes, definitely a very important and busy week indeed. It's starting with tomorrow. Jerome Powell is speaking at the Senate, and probably staying with the hawkish tone that he has had over the last several months, and then waiting like anybody else about any confirmation with the jobs report on Friday. What is interesting about things, especially as you see the signals from the bond market, is the bond markets and the stability of yields in bonds has been a big driver of what has happened in equities. If you actually take a look at, once we got a little bit of a stability at the beginning of this year, that's when we saw the big rally in equities. And since then, that sort of volatility that continued to permeate in the bond market because of that relationship of inflation and expectations for Fed, decisions, that continues to drive a lot of volatility in yields that basically gets into the equity markets.
You said you expect Jerome Powell to continue a hawkish tone. How do you expect the markets will then react to that? Haven't they already priced in, 3 more 25s in a terminal somewhere north of 5?
I think the bigger question right now is the market seems to be very keen into 25 basis points for March 22nd. I think, what the market and investors will basically look into is how hawkish is his tone tomorrow in combination with that jobs report. And I think that is what may determine the possibility of a 50 basis points, increase in the next meeting. And that, I think, indeed, is probably the biggest part of volatility that we're going to see, whether it's going to go to 50 and the probabilities go higher, depends on his tone. Most likely, the discussion that we'll have is the fact that the economy continues to be extremely resilient. Consumers continue to be extremely resilient. And therefore, that idea of being more hawkish and staying on the path of raising rates for longer and even staying longer is probably something that the market, seems to be focusing on.
Yeah, Omar, the economy up until at least now, it has remained very resilient. But if the Fed, what you're saying, does in fact get more hawkish over the course of its next couple of meetings, what does that mean then for the risk of a recession? Does that raise that risk that we've been talking about now for quite some time?
Well, it's kind of interesting because, over the last, I would probably say 8 months or so, every discussion that comes down with recession comes into different flavors. And, I probably think that right now we have probably seen those bold, holistic recession probabilities come, much, much lower than what we have seen probably in the last 8 months. And a lot of that is because if you think about it, there's portions of the economy that are already in recession. When you think about technology, when you think about housing, when you think about manufacturing, they have already seen that effect of the recession. But I think what we have not seen is just that full-blown economic recession that happens at once. And these may be, the way that we will continue to see as we continue to see the effects of rising rates that may be affecting more of the different parts of the economy as opposed to see like a big flow. And I guess that will qualify more like a semi-landing as opposed to hard or soft. It will be more like this rolling landing that we're probably going to see and will continue to see going forward.
So these rolling recessions you referred to will continue until what happens?
Inflation. Inflation is the key driver. I think if we
Right. Are we
think
talking
about
2%?
Well, the long run getting to 2% is probably way far away. But I think the signals that we're going to see from central banks, and particularly for the Fed, will be as long as we can actually see that there is a natural progression towards 2%, we're going to probably see that the market will start, picking up that, and we're going to see the continuity. I would probably say the two areas that we'll need to continue to watch is that volatility in yield will determine a lot of what the expectations the market will have about the Fed, decisions, as well as, when we see that transition and finally stability of that service recession. Because if you remember, the goods recession started to come down, and we saw that peak, probably a couple of months ago when you see the goods recession, the good inflation starts to come down. However, the service recession is still, there. Like everything that has to do with services and those prices continue to go down. And you combine that with the fact that prices for commodities and for certain food prices are not, coming down as fast as people want. I think we're going to see that. So to answer the question, as we actually go from disinflation to actually deflation, that will probably be the catalyst that will allow the markets to just be more stable.
And Omar, when we talk about inflation, a lot of that driven by the growth that we have seen in wages here. We're going to get the latest reading on that on Friday. General consensus for overall jobs, right around 215,000 created. What are you expecting, and what are you expecting to see in terms of revisions potentially lower here for that January number?
Yeah, my expectation is revisions will stay flat. It doesn't necessarily think that it's going to make a big difference. And we expect, wages to continue to go up. Again, that's probably not good news for equities and for risky assets. I think the increased cost of labor, in combination with that, lack of pricing power that a lot of companies use for getting good earnings numbers in the last year, is probably going to put a lot of pressure on margins. It's going to put a lot of pressures in future earnings estimates. So, and we're already seeing, the reports that we saw in the first quarter, show that disinflation setup and that lack of pricing power is already affecting earnings. And at the same time, when you combine that with, increased wages, and we expect, that continuation, in the reports on Friday, we're going to see that margins pressures continue to, be a headwind for equities.
Will be an interesting number ahead of that last massive announcement. Omar, good to see you, sir. Thanks so much. All right, we're just getting started here on Yahoo Finance Live. Coming up, the road ahead for Tesla. The EV maker slashing its car prices again. We'll break down what it means for future and current electric vehicle owners. Then BetMGM CEO Adam Greenblatt joins the program to weigh in on the state of the gambling industry and the company's push to promote responsible gaming ahead of March Madness. And the grind is real for some workers, but it's time to take a break. We'll tell you the best tips for creating a more balanced work life. Don't go away.
Fed testimony, quarterly earnings, and the monthly jobs report. It's a busy week ahead. Here's what you need to know. Fed Chair Jerome Powell will deliver his semi-annual policy report to Congress. Powell speaks to the Senate on Tuesday and to the House on Wednesday. Expect some fireworks. Both political parties have blasted the Fed's aggressive interest rate hikes. Powell has been critical of the standoff in Congress over raising the debt ceiling. There will be fresh economic data for the Fed to consider. The monthly jobs report is out Friday. About 200,000 jobs are expected to have been added during the month of February. The unemployment rate is forecast to stay at 3.4%, a more than 50-year low. Also in the coming week, watch out for earnings from Dick's Sporting Goods, Campbell's Soup, DocuSign, and The Gap.
FTX debtors are filing a lawsuit against Grayscale Investments. Our crypto reporter David Hollerith has the latest on that story. Hey, David.
Hey, Shauna. Yeah, so this just came out in a press release. FTX is alleging through its affiliate firm, Alameda Research, once a hedge fund for Sam Bankman-Fried, that Grayscale, if they were to lower their fees and stop preventing redemptions, would give FTX effectively $550 million more, or approximately 90% more than the current value that FTX shares are today. So this is Grayscale's Bitcoin and Ethereum trust, which both trade at hefty discounts because they can't automatically be redeemed and created as they are closed-ended funds. So what's been going on here is actually shareholders for Grayscale's Bitcoin Trust have raised similar issues with other asset managers coming out to sort of propose taking over the trust. And while most of that has been a bit of a PR campaign, it looks like FTX is also going to try that as a way to maximize value for shareholders. The CEO under bankruptcy for FTX, John J. Ray, saying, "We will continue to use every tool we can to maximize recoveries for FTX customers and creditors." And so their goal ultimately is to unlock the value that's being suppressed by Grayscale's current situation, according to him. Grayscale spokesperson also got back to us, and they've said that the lawsuit filed by Alameda is misguided. They also said that Grayscale has been transparent about its efforts to obtain regulatory approval to convert their Bitcoin ETF or Bitcoin trust fund into an exchange-traded fund. Now, notably, tomorrow, Grayscale is going to start their oral arguments in their lawsuit against the SEC, which is aimed at trying to get approval for that Bitcoin ETF.
All right, David, also Silvergate on the verge of collapse. The bank suspending its crypto payments network after warning about the viability of its business. Shares down more than 90% in 6 months. But despite the worry around crypto-exposed banks, JP Morgan likes one of Silvergate's competitors, Signature Bank. Why?
Yeah, I mean, Dave, I think to take a step back, last week, the events around Silvergate happened so quickly. I think a lot of people started turning around. And, the other the other bank that is a major U.S. banking partner for crypto firms is Signature. Now, there are a few key differences between Silvergate and Signature. And it looks, at least from a financial perspective, that Signature is a lot healthier in that it's a larger company and they have less of a balance sheet proportionate exposure to crypto-relating deposits. So JP Morgan and Goldman coming in today, sort of reiterating optimistic points of view. JP Morgan saying overall, after seeing Signature's mid-quarter update, that it's threading the needle as the company continues to reduce its exposure to digital asset-related deposits. But most importantly, it's at a pace that it's dictating as opposed to the market. Obviously, we saw many crypto firms yank their deposits from Silvergate last week after the company expressed some concern. But notably also, too, I'll point out in Q4 for both companies, Silvergate's deposits fell by 52%. Their total deposits, while Signature's fell by 14%. So it's not quite the same situation. And short interest also shows us that Signature's far less shorted, and it seems to be more favored in the market. So maybe not as complicated or as critical as a view as what Silvergate looks to be in.
Yeah, very important distinctions to make there. David Holler, thanks so much. All right, Tesla cutting prices of 2 of its models again. You can see the stock off just about 1.5%. We'll tell you by how much and what this means for Elon Musk's EV giant next. Let's do a quick check of the market sponsored by Tasty Trade. We have just about 40 minutes to go until the closing bell. You're looking at a mixed picture right now. Stocks well off the highs of the day. The Nasdaq actually dipping into negative territory now, off just about 0.1%. S&P essentially flat, as well as the Dow. Here, many investors, many traders on the sidelines ahead of what is going to be a very busy week for the markets. We have Fed Chair Jerome Powell testifying before Congress coming up this week. Also, that big jobs report on Friday. So the implications there and what that means for Fed policy, that's what the street looks to be waiting for.
Sounds good. All right, Tesla slashing its prices on its most expensive vehicles in the U.S. Yet another cut from the EV giant. Their latest price cuts ranging from 4% on the performance version of the Model S to 9% on the Model X. Meanwhile, analysts at Jefferies raising their price target on Tesla by $50. Yahoo Finance senior autos reporter Pross remaining here with why Jefferies is so bullish. I found this note very interesting, in particular the comparison with the legacy automakers. But I'll let you lead it off with your analysis, sir.
Yeah, well, this is just
You're the expert.
This is what Philippe Houchois of Jefferies had to say, not me. He was actually at the event and said that, the big picture sort of takeaways from that were that Tesla is so far ahead from a cost perspective, from a technology perspective, and then back to your legacy kind of statement, is that because they can drive costs so much lower, they can make better cars with more technology cheaper than the legacy guys can. Legacy guys probably kind of maybe lose a little bit of money here for a while before they can actually get parity with those cars. So he mentioned that, the cost cuts, things like that, better technology, growth in the battery space, better battery technology, but also Houchois got a ride in the Cybertruck. He said it was, quote, impressive, but that he can't actually model how that'll affect bottom line because he doesn't know how much it's going to cost yet, right? So he wants to hear more about pricing.
Do we even have a ballpark?
I mean, when it first came out, when they had that announcement in 2019, they said it would cost $39,000 for the cheapest one. Now, we know that one may take some years to come out. Well, they'll probably come out with the higher priced versions first, 100 grand-ish maybe.
I would have guessed
and then
six
slowly
figures.
come down.
Yeah,
I think for sure the tri-motor kind of high-end one, 100K at least.
Huh.
We gotta get you in the Cybertruck.
Oh,
Both of you guys. You guys need to test it out together.
He's driving.
And Philippe Houchois. Where's Philippe Houchois? Let's get him on.
Exactly. And we should get him on. He's going to tell us exactly what it is, because you got people that are a little skeptical about the Cybertruck right now, right, Pross? Thanks so much. Well, with Tesla cutting the price of its brand new Model S and Model X vehicles, the value of some used Teslas are taking a hit. We want to bring in Pat Ryan. He's the founder and CEO of Copilot. That's an app that helps potential car buyers find the best deal. So let's talk about what you are seeing in the used car market right now. How are these price cuts trickling down to the used car market? And that action, what does that signal just in terms of how much more of a hit these vehicles could potentially get this time around?
Well, it's a really hot car market right now. The new market's up 6.5% week over week last week. The used car market's up 7%. So these price cuts are coming into a high demand market, particularly for EVs. On the used side, there aren't that many EVs available. A lot of the EVs that we're looking at are coming in the future, so they're 23, 24. So that's what dominates this market. They have 65% of the used market for EVs and 86% of the luxury market. So when these prices come down, it's great for consumers. The new prices coming down are going to put more and more pressure. The one cautionary note we're telling our members to remember is this. Elon Musk cuts the prices overnight. They immediately drop. You get the benefit of that on the new side. But on the used side, you have car dealers, people who took those cars in on trade, bought them at a wholesale auction. They're slower to drop those cars because they paid a certain price for them. So we've seen there have been a real lag between when the new car market moves and the used car market moves. And that is almost entirely because of dealers' reticence to lower the price and take the hit themselves. Which means if you're going to buy a used Tesla, it's good to wait.
That is interesting advice. All right, so Tesla, the first time they made their price cuts, we saw others follow, not all of them uniformly. Do you expect that to happen here? And who is closest to the bumper of Tesla when it comes to used EVs?
There's nobody that close to Tesla. I mean, it's amazing how far ahead they are. They have so much inventory out there, so much brand loyalty. There really is nobody close. But I would say on the new side, you heard Rivian and Polestar both say they're not going to cut prices. Lucid said they'll cut prices, but just for March, if you buy in March. So people are afraid to follow. Your reporter was just describing, I think, exactly right, which is the fact that Tesla basically went through the growing pains of learning how to build EVs efficiently earlier and got through that, gives them a margin advantage. They make $9,500 per new Tesla today. They can afford to cut their prices and still be profitable, where their competitors, Ford's already losing money on every EV they sell, and the others will end up with the same situation. So nobody can really do what Tesla's doing. Elon Musk built this competitive advantage. Now he's making the most of it at a time where the competitors are struggling to get new inventory out. In the EV world, they're still playing catch up on that. And now he's giving them another headwind that'll give a tailwind to Tesla sales. The challenge for, I would say, for used buyers is that this has been an incredible 13 months, almost a little over 12 months for Tesla prices. If you look at Tesla stock price, the vehicle prices have been not that different. When the war started in Ukraine last year, gas prices went up and electric prices, especially Tesla prices, took off and went through the roof, peaking in the summer. And they've been going down, pretty much ever since. But what you're really seeing is that there is a delay now between when the new car price drops hit and the used car prices hit the market because of that lag of dealers hoping to sell you cars for what they paid for it, which is why the savvy consumer waits, watches the market, and either buys new now because it is attractive pricing, or waits for the used market to get there. Carvana liquidated a lot of them, so there was some inventory there. Not clear how much they have left. And the rest of the dealer world is hoping to get out of those cars without too big a loss, which means that buying now could actually cost you a lot of money, or if you wait 30, 60, 90 days, this price change will really clear through the market. You'll get the benefit then on the used side like you're on the new side today.
All right, Pat, so Tesla aside, let's talk about what else is going on in the used car market, because we certainly had seen prices trending down in the direction that was favorable here to buyers. Some talk, though, that momentum is starting to shift, and we might be seeing an uptick here for the month of February. Is that consistent with what you're seeing? And what do you, expect here for the used car market looking out over the next couple of months, given the fact that the spring is a very popular time in terms of car buying season?
Well, we're in tax buying season right now. The refund checks peaked, I think, a week or two ago. But there's no question that, we've seen the wholesale prices go up. You've seen that in some of the Manheim data. Of course, during the pandemic and even after, we saw wholesale prices go up, I think, 9 times, where retail prices only followed twice. This will be the third time, though, retail prices have followed. We're seeing both big increases in sales, like I said, almost 7% week over week increase in used sales last week. And we're seeing prices go up. Prices went down from pretty much Labor Day all the way through the beginning of February. Retail prices treaded water on used cars during the month of February. But the last 2 weeks, we finally are seeing prices pop back up a little bit. I think the Fed's going to start getting very nervous. It appears that the rate increases they've put in place just haven't had the slowing effect on the used car market the way they expected, or the new car market, which is up 6.5%. week over week. So I think we're in a position now where it's really a time to pause, because with the demand that's out there, there's no chance that the Fed isn't watching this. They've watched the used car market and the new car market very carefully, and those markets are heating up again. We're seeing really a strong increase in volume, strong increase in pricing, strong consumer, like you see in the job market, following through in the way it isn't in some other markets. And they have to cool this down. And when they do cool it down, I think you'll see prices start to soften again, but we're not going to see it in the month of March, doesn't look like.
Wow, yeah, JP Morgan has a study out saying they believe 10% they will fall in terms of used car prices this year. Clearly not seeing that yet. Pat Ryan, good to see you, my friend. Thanks so much.
See you.
Coming up, housing headwinds ahead. JP Morgan downgrading 2 home builder stocks today. We'll tell you which ones and why on the other side of the break.
time for Triple Play. 3 stocks that we're watching in the final 30 minutes of trading. We've got KB Home, Dick's Sporting Goods, and also Disney. Well, my play today, it's actually 2 stocks. So we do have KB Home, but also DR Horton. JP Morgan downgrading both names on softness in housing. Now higher mortgage challenges with a 30-year fixed rate hitting its highest level that we've seen since November. And that jump in rates have moved potential home buyers to the sidelines, with mortgage applications declining 3 weeks in a row to a 28-year low. So as a result, JP Morgan making the case that fundamentals in the housing market may go sideways or potentially soften over the next quarter. Analyst Michael Rahout there cutting the bank's rating on DHI to neutral, double downgrading KBH to underweight. The home builders have actually performed okay since the start of the year, really outperforming the broader market in many cases there. But the higher mortgage rate, the fact that the 30-year rate seems to be trending to the upside, obviously here a headwind, a risk here for the housing market.
And we've seen the same thing with home prices, right? And it really just aligns with all of the housing data I feel like we've been seeing, at least generally speaking. With Case-Shiller data last week, 6 months in a row now, we've seen month over month that price decline. And they noted last week too in that release that home prices may continue to weaken moving forward. So really something that we're not just watching right now, but it seems like that trend, Dave, is kind of continuing. So then what does this mean for the home builders, not necessarily now, but say over the next 6 months? And maybe that's not the best picture.
Yeah, it's a really tenuous time. And this is ahead of Jerome Powell's. We talk about everything in the context of Powell speaking to Congress this week. Will he further dampen the news in the housing sector? And it feels like yes, because I think mortgage rates are at 6.65 last week. Some actually have them north of 7. Mortgage News Daily has them already north of 7% on the 30-year. And I think either way, they are headed back north of 7% in the next month, maybe the next 6 weeks, which is a gain of more than a full percentage point in just over a month's time. This housing market is really going to contract further in the months ahead. I can't imagine any good news in this environment, especially given the hawkish tone we're expecting from Jerome Powell tomorrow. It just feels like a tough time ahead.
It almost makes you wonder in some ways too. I know there was a story on the banking sector and talking about rates. When you think about rising mortgage rates, do you consider buying now if rates are going to go back up even higher? I know you're not getting. I
think it's just.
I know you're not getting a deal, but as you're talking about it going up above 7, if you're really that interested in buying, maybe you're just never going to get that deal.
Yeah, but the hope is that home prices are going to tick back just a little bit to make it a little bit more of an attractive deal for you. But I mean, still.
The buyers
year over year,
the buyers I'm hearing right now are cash buyers. When I talk to realtors across the country, that's the action they're seeing. People that have nothing to do with these mortgage rates, and I think that's what we're going to see for the next couple of months.
And that's why first-time home buyers being priced out for the most part. Yep.
Yeah.
All right, my play today is Dick's Sporting Goods ahead of the company's quarterly earnings report expected to be released before the bell Tuesday. Now, the report will give us another glimpse at the consumer and any potential weakening demand. But for Dick's investors, this report is likely going to be all about the margins. The street expects Dick's to report higher fourth quarter revenue than the year prior, largely driven by the promotional environment over the holiday period. But the key will be how much Dick's has been sacrificing on the bottom line to boost that revenue and offload inventory. Now, credit card data last week from Citi shows that Dick's is leading other sporting goods retailers, but in that same research, the firm downgraded the stock to neutral from buy, noting it expects near-term gross margin pressures to continue. Barclays is in the same camp, lowering expectations for gross margins last month. The street consensus on that number, gross margins, currently sits at 33.5%. We'll be watching that before the bell tomorrow. That would be the 6th straight quarter, Dave, of margin declines for Dick's. Some people had thought they might turn the corner here. It doesn't seem like that's quite happening just yet. Dick's up about 10% on the year. Interested to see the report tomorrow.
Yeah, and this is just a few days after Morningstar named 10 stocks they believe are currently overvalued. Just 10. And Dick's Sporting Goods, unfortunately, was one of those 10, saying they lack an edge and that sporting goods retail in general has been minimal due to external competition. So not great news ahead of earnings for Dick's. Did you have anything to add there?
Yeah, certainly. I was going to say just the environment right now is so tough for any retailer out there. We know Dick's is trying to diversify their business. They did have that recent acquisition of Moose Jaw just because the play there is for their online business where e-commerce sales haven't exactly been doing too well at Dick's. So they're betting big there, betting on the outdoor apparel, hoping that might be able to shift the trend there. But
Hoping
we'll see.
that COVID trend continues.
Yeah, exactly.
Big buy from Walmart. My play is Disney, with the clock still ticking on Bob Iger's second stint as CEO. Speculation is swirling regarding his succession plan. With that, Fox Business reporter Charles Gasparino reporting over the weekend that NBA Commissioner Adam Silver leads the short list. Gasparino says other names on that list of possible successors include Candle Media co-founder and co-CEO Kevin Mayer, Disney co-chairman Dana Walden. As for Silver, I contacted the NBA chief communications officer. He said we have no comment on that Silver report. The commissioner is under contract with the NBA through the 2024 NBA Finals, which kind of adds speculation here because Iger has said he'll stay on at Disney for 2 years, which would end in late 24. More, well, the NBA's media deal, for which Disney is expected to bid, expires after the 24-25 season. So there's a lot of fuel to this fire. Disney shares flat really today, up 13% this year. If you want my best guess here, I think Adam Silver has one of the best jobs in America. He's excellent at it. I think he is the best commissioner in all of professional sports. He makes a boatload of money, and he has a lifetime of job security. It's a great job at Disney. Don't get me wrong. His comp would increase. I don't think he's going anywhere.
But expanding on Adam Silver, though, and making sense of maybe why it could be that Disney sees him as a candidate more so than Adam Silver sees himself as a potential Disney CEO,
point,
right?
Josh,
and I think when you think about Silver and what he's built out when he was working on the NBA entertainment side and sort of their media property there, and then you think about the characters. We've talked a lot about this with what maybe Netflix should copy from Disney in some ways, but Adam Silver has really built the NBA in this next generation around characters, right? When you talk about like a Steph Curry and what they've done with the Warriors and how sort of that relates to Disney's brand in some ways, where you have shows, you have popular characters, you franchise them, and you build around them. So I think you can see the comp there for maybe why Disney might like Silver. You have a great point, Dave. Yeah. All three of us love sports. I think if I was ever a professional sports commissioner, I'd probably rather do that and hang out and watch games and do that part of the job rather than do earnings calls, but maybe that's just us.
Right.
Yeah, I was going to say, well, you make a very compelling case as to why Disney would have the focus on Adam Silver. Yeah. If Adam Silver, though, isn't in the mix, if he decides that the NBA is for him, he doesn't want to take on the big shoes to fill, that would be Bob Iger. The two other names that you mentioned there, Dave, from Gasparino's reporting, Dana Walden, she has been in the mix now for quite some time, but Kevin Mayer, his name keeps coming up time and time again. Remember, he was also rumored to succeed Iger the first time around, ended up leaving after he was passed over, was at TikTok for a little bit. I wouldn't be too surprised if we end up settling on Mayer this time around, but we'll see.
No surprise that names are being floated because Iger has to get it right this time. So you want the media
2 years.
You want the media to begin vetting these people whether they have a chance or not. Give it some time for the media to pick apart. He'll get it right.
We'll see if Adam Silver ends up being in the mix here in 2 years from now. All right, well, coming up, the journey to retirement is not easy. When we come back, we will tell you the most common Social Security misconceptions that are tripping up millions of retirees. Stay with us.
Social Security benefits aren't always easy to understand, but a bipartisan group of lawmakers want to change all that. In a draft letter to the Social Security Administration, lawmakers write that evidence shows delaying a retiree's claim of benefits past the age of 62 is, quote, financially advantageous for most Americans, as it provides them with a greater monthly benefit for the remainder of their lives. As of right now, if you claim your benefits at age 62, born in 1960 or later, around $1,000 monthly benefit would be reduced 30% to $700, Shauna. That's a whopping $300 loss. And according to the Social Security Administration, 62 is still a common age for Americans to claim their benefits. But in 2018, 35% of men and 40% of women aged 62 began the program. One study has found retirees collectively lose $3.4 trillion because they claim Social Security at a, quote, financially suboptimal time that shakes out to a loss of $111,000, $100,000 plus per household. Lawmakers want to close this gap and encourage people to claim their benefits later. If you got all that, my friend.
That was a lot to digest
notes?
there. Yeah, the takeaway, you're leaving a heck of a lot of money on the table if you claim Social Security early. So let's talk about what these policymakers want to do to accomplish all this. Senators are proposing a new bill pushing for two changes. The first is for Americans to receive explainer paper statements starting at age 25. Now, these statements would help Americans understand their retirement options and get updates on where they stand. You would first get these statements every 5 years. The frequency of the statements would increase to once every 2 years at the age of 55. And then you get annual statements starting at the age of 60. The idea is that at that point, you would have had more time to prepare and educate yourself on the best option, so you won't be leaving that money on the table. So that's the first change that lawmakers want to make. The second change has to do with the language. If you claim benefits starting at 62 years old, it's currently referred to as, quote, early eligibility age. Now, lawmakers want to change that to minimum benefit age to better communicate that if you cash out starting at 62, you're getting the minimum monthly benefit. Full retirement age would change to standard benefit age. And delayed retirement credit would change to maximum benefit age. So really putting it in plain English for everybody.
I think I'm 62 now.
You're not too far. It's going to be here before both you and I know it.
I just aged was the point. For more on this and all things Social Security, we're joined by Matt Rutledge. Matt is a research fellow at Boston College Center for Retirement Research. Good to see you, sir. I hope you got that breakdown. How concerned are you by this trend of early takeouts at the age of 62? How big a problem is it for this country?
Well, I think for most people, it is a problem because it means that they're not maximizing their Social Security lifetime benefit. Given that the program is set up to give people roughly the same amount of money no matter when they claimed, but it was set up to do so based on life expectancy around 1960. And while we've seen a little bit of life expectancy decrease in the last couple of years, for the most part, we're living a lot longer than we did in 1960. So the benefit that you get for claiming later is actually better than it should be. And as a result, I think when people claim their benefit at 62 or some earlier age, they're really leaving a lot of money on the table.
And Matt, what are you seeing just in terms of, we highlighted the fact that more women seem to be tapping into Social Security at a greater rate than men, at least when it comes to doing that early at 62 years of age. Why is that the case? And what else can you tell us in terms of the breakdown of who is tapping in early, who isn't, and the amount of money that we just talked about being left on the table?
Yeah, women especially, I think, are leaving money on the table by claiming early. In part, that's because they tend to be the younger spouse in a heterosexual couple, and couples often want to retire together, which might mean that the younger spouse has to leave a little bit earlier at a younger age. Could also be that job prospects aren't quite as good for some women, especially as they get older. Age discrimination is definitely worse for older women than it is for older men. There's also a bunch of people that would probably stand to gain by claiming a little bit later because they're going to live longer than they thought they would. We actually don't see much of a relationship between poor health and claiming early, in part because some of the people in poor health have pretty poor job prospects, pretty poor savings prospects, and as a result have to stay in the workforce a little bit longer. But you could conceivably see people claiming early just because they they're not quite at the level of needing disability benefits, but they're also not able to continue working at at the level that they're used to working. We're also going to probably see that more people with 401ks are going to claim a little bit later, despite the fact that they actually have more retirement savings than the people that don't have 401ks.
So, Matt, how do you evaluate this proposal from a bipartisan group of lawmakers?
It's great to see some kind of conversation about Social Security reform that's not just fear-mongering. But I think this one in particular is actually really well designed because it's not reducing Social Security benefits at early ages. The people who are getting those benefits at 62 often are the ones that are the most reliant on the program. And if they just raise the early retirement age, from 62 up to some level like 64, you'd probably see a lot more people just get on disability instead, and the system really wouldn't save any money. It's also not necessarily going to result in a retirement benefit increase, a retirement age increase. That would be really a benefit cut. All that's really happening here is a relabeling to make things a lot simpler. We really shouldn't be using terms like full retirement age because that implies that that's the maximum benefit you're going to get. Right now, the full retirement age is about 66, 67, depending on when you were born, when you can really continue to get benefits increases every year, every month that you delay your claim, all the way up to age 70. So really changing the language just a little bit to give people that signal that they really should try to wait to 70 if they can. And of course, not everybody can, but those who can really could benefit a lot by postponing their claiming, even just a little bit.
Well, Matt, when we talk about the fact that Social Security programs, lots of uncertainty about that future, the bipartisan talks, some are underway down inside the Beltway to shore up that program. From your perspective, what needs to be considered when we talk about making even additional changes to Social Security down the road?
Well, this is just my opinion. I'm somebody who really thinks that Social Security is probably the most important and the most simple retirement option that we have. Well, it'd be great for more people to save more on their own. The numbers show that more than half of people are relying on Social Security for more than half of their retirement income. And there's lots of people that rely on Social Security for almost their entire income, which means that we really can't afford to cut Social Security benefits. Even something that's more of a technical change, like reducing the cost of living adjustment or raising the full retirement age, is probably going to hurt people pretty substantially, although not as badly as just allowing benefits to be cut by 20%, which is what happens if nothing happens. Instead, I think some sort of a combination of, maybe a slight sort of gradual change to the retirement age to peg it to life expectancy, coupled with more money coming into the program through taxing higher income taxpayers or by allowing state and local employees to finally be part of the system, I think would actually make a lot of sense and would make it so that we don't have to have these conversations every few years about whether we can count on Social Security continuing to exist.
It is welcome news. There is finally some conversation, to your point. Matt Rutledge, thanks so much. Appreciate that. We'll be right back.
Let's take a look at the 10-year yield, just below 4%. It did break above that key level earlier last week. Lots of talk about high inflation, persistently higher rates from the Fed, what exactly that means for the market. A lot of that responsible for the move that we saw in the bond market. In terms of the equity market, the three major averages, a bit of a mixed picture. The Nasdaq still trending lower here in the final minutes of trading, off just about 0.1%. Dow now up 50 points in terms of the sector action. Leadership there from technology, utilities, materials is a laggard today, off just about 1.6%. Coming up, we are counting down to the closing bell on Wall Street. We'll be right back.
All right, just a few minutes away from the closing bell. Time to bring in Yahoo Finance's Jared Blickery to break down the market action. Relatively muted on this Monday.
Yeah, so you're not seeing a whole lot of action in the majors, not a lot of individual movers anyway either, but we're going to go over some of the stats. Dow is going to be up 4 days in a row unless it falls out of bed in the remaining minute here. S&P 500 about to be up to the highest level in about 2 weeks, but we're only looking at a gain of 0.1%. Nasdaq just barely in the red. Russell 2000 though, small caps down about 1.5%. And let's take a look inside the market here. Under a minute to go, and here are the sectors action. Here's the sector action for today. Utilities, tech, staples, financials, all of those outperforming. Utilities in the lead. Materials are the biggest laggard, down over 1.5%. You take a look inside the Nasdaq, it's a mixed board. Apple, Microsoft, Alphabet, all in the green. I'll show you something interesting too I was noticing here. A lot of the software names in the green, but still within the realm of tech. A lot of the semis simply red. So kind of a bifurcated day in tech. And really, we're going to wait for tomorrow. Here's the closing bell.
All right, that's the closing bell, sponsored by Tasty Trade. A lot of excitement up there. There we go. The gavel. Rate it. What do you think?
That was a solid 8 because the fist pump that preceded the hammer.
Yeah, and the full body motion into banging that hammer. All right. Well, we are looking at a mixed day as we start the week. The Nasdaq closing off just about 0.1%, where it spent the majority of the final hour of trading. Dow and S&P closing just to the upside. The Dow barely holding on to gains, up just about 40 points.
Shares of Apple, meanwhile, popping on this day after Goldman Sachs started a coverage with the buy rating and a $199 price target, implying some 30% upside on the stock. Analyst Michael Ng writing in a note, quote, the installed base growth, secular growth in services, and new product innovation should more than offset cyclical headwinds to product revenue. Ng noting that services should lead the way over the next 5 years. No huge surprise there, but rising by more than 40% by 2027. The note on the heels of Morgan Stanley on Friday listing 5, quote, underappreciated reasons Apple could move higher over the next 12 months. That's largely driving all the action that we see, which is relatively none. But more good news piling in for Apple after a pretty quiet quarter.
Yeah, certainly. That note that you mentioned there at the end from Morgan Stanley, they highlighted 5 catalysts that are driving that. Not only do they think Apple's going to reclaim that $3 trillion market value, their bull case saying that it could actually get to $4 trillion. And similar with the note that we heard out from Goldman Sachs today, one of the catalysts there is the services growth, the reacceleration that we are expected to see there. Morgan Stanley also noting pent-up iPhone demand. When it comes to the Goldman note, though, I want to point out this is the first time we have seen a buy rating on Apple from Goldman Sachs in about 6 years. This analyst that is overseeing Apple is a new analyst covering the stock there. When we talk about the size of the ecosystem, the strength of the ecosystem, Apple has 2 billion active devices last quarter. That's a record. Now the strong growth up from 1.8 billion year over year. So from January of 2022, up from 1.5 billion at the start of 2020. That growth is pretty rapid. You can't argue with that type of growth, with that type of momentum to the upside. Over 2 billion devices speaks to the fact that that ecosystem is so sticky. And once Apple gets you inside their world, gets you to buy one of those products, the likelihood that you're going to buy a second, third, fourth, maybe even fifth is pretty high.
Let's see, what do we got right here? 1, 2.
I have
you have 3. I've got 2. We've probably got 2 more
AirPods upstairs.
We're a pretty good example of that ecosystem. And then they'll get you with the Apple TV and the Apple Music down the road too. There are a couple of maybe pump the brakes observations. There has been rumors, and we're going to circle back to the DOJ in a moment, but the DOJ long rumored to be wanting to go after Apple's App Store. And will they begin to crack away at that 30% surcharge? That's the one thing you have to wonder in the services department. We have noted clearly, and again, we will elaborate in just a second, how this administration has gone after tech. You have to imagine these rumors about them going after the App Store will indeed happen. And what will happen with the new iPhone? In September, that's when we expect the iPhone 15, and we haven't seen any really bold innovation when it comes to the iPhone. No real reason to run to the store and get that new model. They need to give you something. The upgraded cameras haven't done a lot for people. We've talked about your lack of upgrade for quite some time, and clearly nothing is making you run to the store.
I should.
And that backs up my point. I think they need to give you a reason to upgrade.
I don't know what would give me a reason other than actually my camera full out breaking on this would be the reason for me to head to the Apple Store and upgrade. But that has nothing to do with what's included in the latest device. Oh my gosh, you guys are doing it up. Here we go. Close up on my phone.
Your watch?
It's a 10.
You know, it goes better. It works better on your wrist.
This is getting very personal here with me and my Apple.
It's weird about Apple. They work better on your wrist.
All right. I know. Well, actually, for the first time, it's not dead. So we're making some progress here on this Monday afternoon.
Okay, so we will talk now about the Department of Transportation and the Department of Justice are expected to file suit to block JetBlue's pending $3.8 billion acquisition of Spirit Airlines as early as Tuesday. That's according to new reports. It's the Biden administration's latest anti-monopoly move as it expects the deal to close cause potential harm to flyers by limiting choice and increasing prices. JetBlue's CEO Robin Hayes told the Wall Street Journal Monday that he expected the lawsuit tomorrow, adding that when his airline enters certain markets, traffic increased and prices declined. The airline says passenger counts on flights between Atlanta and Boston, this is what they call the JetBlue effect, they rose 48% after they entered the market, while they say average fares fell 45%. So that is a very strong argument against what the DOJ is rumored to be doing. JetBlue and Spirit's argument before DOJ is essentially that they must merge in order to compete with the big four legacy airlines. To address the DOJ's concerns, JetBlue has offered to sell off Spirit's operations at Newark Liberty International in New Jersey, at LaGuardia, at Boston Logan in Massachusetts, as well as 5 slots at Fort Lauderdale Hollywood International in Florida. Not on the table was an offer to abandon JetBlue's Northeast alliance with American Airlines, which the DOJ challenged in court last year and is awaiting a ruling from a federal judge in Boston, Shauna.
That's a lot to digest there. I think the takeaway here is a crackdown from the Biden administration. What exactly that means here for other larger types of mergers here going through in terms of what it means for JetBlue and for Spirit. Spirit closing off nearly 9% today, the biggest intraday drop that we have seen now in quite some time. When it comes to some of that data, you mentioned the fact the uptick that we're seeing in the traffic between some of their I guess most important or some of their key flight routes here. JetBlue also saying that as of their latest data, a combined JetBlue and Spirit will only account for about 9% of market share. That might initially sound like a lot, but when you compare it to the largest airlines out there, the 4 largest airlines, they account for about 16 to 24% within that range. So certainly they would still be viewed as a much smaller player when compared to the 4 largest airlines. When it comes to the Department of Transportation, this move here, blocking a certificate, is certainly unprecedented when you take into account that this hasn't happened since the industry was deregulated back in 1978, excuse me there. So certainly lots of questions about what is ahead for this merger, whether or not it's going to go through. JetBlue saying that they're going to fight it. We'll see.
I think Robin Hayes has, on paper, a very solid argument. He's got numbers to show what's happened when they combine in those markets. And look, what's going to happen? Yes, are prices on Spirit going to increase? They naturally have to. They're going to pull out chairs. They're going to make Spirit Airlines much more like JetBlue. And if you fly JetBlue, they've really done a tremendous job of upgrading their planes. There are roomy seats, there are televisions. I got to say, it's been a really pleasant experience. So prices would naturally increase a little bit on Spirit, but it doesn't seem to have that anti-competitive impact that the DOJ would suggest here. But this is the Biden administration going after Google. I mentioned rumored to be going after Apple, going after Activision Blizzard. This is an administration who is going after these big mergers. Will it have a chilling effect across other industries? Can't help but wonder.
We'll see, yeah. You would think so, at least at this point.
All right, Twitter users forced to deal with another outage today. Dan Howley here with what happened this time. Dan, it's been a mess there. What happened today, and does this at all have to do with the fact that Elon has just taken a hatchet to the employees at that place?
Yeah, it's hard to tell whether or not this is actually an issue that relates to the layoffs that we've seen at Twitter, though they have been massive. I mean, more than half the workforce there is gone. They're essentially working, at least as far as reports go, with a skeleton crew. But what happened today was there was an issue with an API, which is basically a piece of code that allows you to plug things into Twitter. More or less. So if you were on Twitter and you were trying to do things like load images, videos, or even links to news articles, you weren't able to see those. You would get this error code showing that there was a problem with the API. And, for the vast majority of Twitter users, they couldn't see what they normally use the app for. Sure, you could read text, but when it comes to advertisers or news organizations or creators, that kind of content that they would normally post just wasn't there. So the main reason for all of those firms for using Twitter just disappeared in an instant. It did come back online, but when you keep seeing these repeated problems from a company like Twitter, when we have Elon Musk on there talking about how engagement is huge, you have to wonder then, where the final breakdown will be. Will they start rehiring people, or are we going to see some kind of catastrophic failure of the service in the future?
Yeah, and speaking of that, I was just reading some stats here. This is the 6th time that we've seen a major Twitter outage in 2023 compared to 3 in the same time frame last year. When it comes to questions about concerns about Twitter's stability, how do you view that at this point and what we've learned from the Twitter outages, if we should actually continue to expect these type of outages here over the coming months, given the fact that headcount is only a fraction at what it once was?
Yeah, I think, look, that's something that's just going to happen now. If I was a betting man, I would say that there's probably going to be some other kind of outage in the future. I mean, you could say that about really anything that's online. That's just, the nature of the internet. But with Twitter in particular, it seems to be a larger problem just because, as you said, there have been these major outages that have been happening so frequently so far this year alone, right? And we're in, I don't know, March. So not a great look. And I think for a lot of people who depend on Twitter, it makes them question whether or not they should continue to stay on the platform or instead go to something else, whether that's Meta or Instagram, TikTok, Snap, something along those lines. Really the big thrust of Twitter is that's where a lot of thought leaders go. That's where a lot of researchers go and a lot of journalists go, so you can get the news easily. There's not a lot that can fill that. We'll have to see if Twitter can keep holding on as long as they can.
All right, we'll see. All right, Dan Halley, thanks so much. Well, last month, Airbnb CEO Brian Chesky saying that his company would not be conducting layoffs. Well, things have certainly changed. It seems like we're going to tell you all about it when we come back. Airbnb laying off about 30% of its recruiting staff, even though the lodging rental company is saying that it still plans to expand its overall headcount this year. Now, these latest cuts come less than 2 years after a 25% reduction in staff in the early days of the pandemic. We want to bring in Yahoo Finance's Ali Garfinkel. And Ali, I think the cuts here from Airbnb came as a bit of a surprise, given the fact that Chesky said he didn't have plans to do so not too long ago.
That's absolutely true, Shauna. But to be fair, let's start by being fair. These layoffs are a small percentage of Airbnb staff. The cuts we're talking about here are about 0.4% of the company's total workforce of about 6,800 workers. I did some back of the napkin math, and that shakes out to about 30 people in recruiting, which of course is difficult for those people, but isn't a mass layoff by any stretch. That said, this is not exactly what Brian Chesky was promising in the company's earnings call just 3 weeks ago. Take a listen.
We have a general philosophy that we want the very best people in every field to come to Airbnb in every function. We're functionally organized, And I think that, we're one of the few tech companies that isn't, doing layoffs. We're not cutting. We're not freezing. We're actually stepping on the gas. But in our mind, stepping on the gas doesn't mean adding a huge amount of people. We're going to continue to stay really lean, but we're really focused on just really hiring in key positions.
In that call, Airbnb's CFO went on to say that he was actually expecting headcount to grow this year between 2 and 4%, which, to be fair, is down from about 11% last year, but still would be a modest growth. That said, what do we make of this in the context of the layoffs we've just seen? What should investors think about them? And I think the answer is to look to Chesky himself. Today, he's expected to speak at the Morgan Stanley TMT conference. And my big question, and I'm sure I'm not the only one, has there been a change in how this company is approaching cost cutting? And will we see his tone shift?
Should be interesting to find out. I'm just curious if you really did back of the napkin math. You're way too young to have ever done back of the napkin. Like, that's old guys like me. You do iPhone math. I just want to be clear about that.
I will bring you the napkin, Dave.
All right. Are there other CEOs who have made similar promises only to back away from them, Allie?
In some sense, yes. Back in November, for instance, reportedly CEO of Facebook, Meta, CEO of Meta, Mark Zuckerberg, said that he didn't anticipate more layoffs just after cutting about 11,000 people. That said, there are reportedly more layoffs set to happen at Meta in the coming weeks. However, I don't know if I put this in the same category as Chesky. I think the writing has sort of been on the wall on this one for a while. For example, in Meta's earnings call just a couple of weeks ago, we heard them saying efficiency, cost cutting, and that often translates to something like layoffs. And I think the bottom line here, Dave, really comes down to a bigger point, which is that we've been talking about this deluge of tech layoffs for 6 months or more, and it doesn't seem like it's coming to stop. So far this year, data suggests that more than 120,000 tech employees have lost their jobs. So we've been talking about this flood of layoffs since mid-2022, and it's not stopping. And I think that's maybe the most important thing to remember.
Also not denting that labor market, though. Massive job creation, still very tight overall. And still, when you look at tech, it's only about 2% of the overall labor force, so relatively minimal when you talk about the country's workforce as a whole. Allie Garfinkel, great stuff. Thanks so much. Coming up, raising the stakes, BetMGM CEO Adam Greenblatt joins the program to discuss its commitment to ramping up responsible gambling and what lies ahead for the industry as March Madness lies right ahead of us. back, and a quick check of the markets now, sponsored by Tasty Trade, as the markets await words from Jerome Powell ahead of Congress the next couple of days. Relatively muted action on this Monday. As you can see, the Dow in the positive, albeit just barely up 40 points, and the S&P 500 just barely eking out gains, and the Nasdaq falling 13 points on this day. Selection Sunday for this year's men's basketball NCAA tournament is less than a week away, and this March might be more mad than most years for Vegas operators. The home of gambling in the U.S. set to host Sweet 16 and Elite 8 games later this month. This brick and mortar boost comes as online sports gambling continues to roll out state by state. Here to discuss the growing market of online sports gambling ahead of March Madness is Adam Greenblatt, BetMGM CEO, along with our senior gaming analyst, Josh Schaefer. Good to see you both. All right, Adam, let's start with you. Good to see you, man. So given the additional states that have come online, given the hoops that we mentioned, March Madness in Vegas, what are your expectations for this as a gaming moment the next couple of weeks?
So March Madness is one of our tentpole events of the year, and in fact, over the course of the tournament, we see more action than the Super Bowl collectively. So this year will be leaps and bounds ahead of any year prior, and even ahead of this year's Super Bowl. So really looking forward to it.
And Adam, you have those games in Vegas this year. Obviously, MGM. It seems like part of the product with BetMGM is to get BetMGM users to then go also to MGM, the brick and mortar business itself too, right? I'm curious how you think those games in Vegas might play into that strategy and if you think you're going to see a boost there.
Well, omni-channel, it's a great question. Omni-channel is central to BetMGM's strategy. In all of MGM's properties in Las Vegas, you will find a BetMGM sportsbook. And what we do is we recruit players who are in Vegas, perhaps for a visit or even visiting the property and are locals. But we recruit them to digital as part of their retail experience. And what that means is that we develop an active relationship that we continue when that patron gets home, when that patron goes to a sports betting state. And in the other direction is also important for us, because success looks like driving traffic to MGM Resorts properties. And we found that this year, 2022 rather, about 50%, it's just around 50% of new MGM Resorts Rewards members were driven by BetMGM. So we're pretty excited about this omni-channel relationship.
You mentioned March Madness exceeding even the Super Bowl. It's still only 3 weeks ago. In reflection, do you have any numbers just how much bigger that event was, given that you've got 36 states now allowing legal sports betting, 26 that allow mobile sports betting? And do you have any predictions about what lies ahead with the Vegas Super Bowl this year?
Well, let me start with Vegas first, because that's the part that I'm most excited about. 2024 is going to be enormous for us. The rules, the regulations of that drive participation, govern participation in Nevada are different from other states, which means in Vegas, MGM is king. And so we're very much looking to capitalize on the fact that MGM accounts for about 40% of hotel stock along the Strip. And Allegiant Stadium, where the Super Bowl is going to take place, is just across the highway from some of MGM's iconic properties like the Mandalay Bay. So we're expecting a huge number of people to walk through MGM properties as part of their Super Bowl 24 experience. And of course, only Vegas can do parties Vegas style. So I think next year's Super Bowl is going to be the best yet. In terms of numbers, there are in anticipation of March Madness, we've been really actively focusing on efficiency within BetMGM. So what that means is invest less in those who are more interested in perhaps promotional participation, and more in those who are sincere sports bettors who like our brand, who like our product. So there's in terms of volumes, there's a plus and a minus. So net, my expectation is we'll probably be about 20% up on bet count, but I think that's a conservative estimate.
Adam, it is problem gambling awareness month as well, and I'm curious what you make of MGM's push there. What is MGM sort of hoping to get out of this month as far as awareness goes? And then also as a company, I mean, how do you balance that with, obviously you want more people to gamble and you want more business to come in to the book itself. So how do you sort of balance those two things there?
Look, this is an existential issue for our sector, for our business. And frankly, it's not just MGM, it's BetMGM that is championing this initiative along with MGM Resorts. We have a number of initiatives to ensure that the relationship with our product is fun and entertaining. You know, and we're investing in research. We're investing in our partnership with award-winning problem gambling program GameSense, which really focuses on positive interaction, educational interaction, and of course the provision of resources to those who might be looking for extra support with their gambling. We're, as I say, investing heavily in research to take the myth away from problem gambling, raise the profile of gambling being a leisure and entertainment experience, and frankly demonstrate to the naysayers that we are sincere about this effort. And why? Because we don't get in front, we as an industry, as a business, get in front of this issue, we don't have to look far outside of the US to see what lies down the road. And just to put a finer point, a monetary point on this, since the beginning of 2021, BetMGM has paid taxes of more than $1 billion. $1 billion of tax in 2 years, right? This is an important aspect to get right with our industry, with our stakeholders, which include regulators and lawmakers.
And the National Council on Problem Gaming says that 60 to 80% of high school students have legally gambled in the last year, and that 4 to 6% are actually problem addicted gamblers. I confess, I have a 15-year-old who gambles on a daily basis. I'm told they play online poker in class. You said you're doing research. Are you aware of that problem among our nation's youth, and how concerned are you?
So I think what you've just shared is a really compelling reason why every state should have regulated, lawful gaming, because it's happening everywhere. It's happening in an unregulated fashion everywhere. We, BetMGM, know every player who we interact with, where they are. They've gone through KYC. We know that they are over age, so over 21. We know exactly where the bet takes place. We know all of their betting history. And so with our sophisticated analytics, we're able to then start to see patterns in the data, start to see player level behavior. And so where's the future? Whereas the future is analyzing at a player level changes in behavior, which are the early signals, the early signs of a problem starting to arise, and we can intervene. I have a whole team of people whose only job it is to interact with players for whom there is some concern or some questions. Now, illegal and unlicensed operators don't have that and are not committed to maintaining a healthy business as we are.
And we parents probably need to do a better job, I confess myself. BetMGM CEO Adam Greenblatt, Josh Schaefer, thank you both. Excellent discussion. Coming up, raising a child, not cheap, but there are some tax breaks that can help ease that financial burden. We'll tell you about those when we come back.
Soaring inflation is putting a burden on many Americans, especially parents, and the cost of raising a child is becoming even more expensive. A recent study by Brookings Institution estimates that the cost of raising a child for a middle-income family with 2 children will exceed $310,000, and that adjusts for future inflation. We want to bring in Emily Irwin, Managing Director of Wells Fargo's Wealth and Investment Management Division. Emily, it's great to see you here. So that $310,000 number that I just referenced, first just break that down for us in terms of what that spending is going to look like on an annual basis and where parents, where caregivers are spending the most.
Absolutely. Well, thanks for having me. It's the basics. It's everything from food, clothing, shelter, healthcare expenses. And so those all add up. It does not include the cost for higher education, however. That is an additional whammy that gets added on at when the child decides to do higher education.
A far more significant whammy, isn't it? But you say there are tax planning opportunities to consider, and we'll start with one, the Child Independent Care Credit. How can that help? How do parents utilize that?
Well, this is great for working parents. So if you're a parent who is either currently working or is looking to work and you have a child under the age of 13, this is a credit available to you. You can take up to 35% of your child care expenses that are qualified, up to $3,000 per dependent, or up to $6,000 if you have 2 or more. Additionally, it's also available if you have qualified care expenses for an incapacitated spouse or even an adult who's dependent upon you.
And how do you claim that credit in terms of, and also not only how you claim it, but do you start phasing out of the eligibility in order to claim that credit if you make a certain amount of money?
You do. There are phase outs for many of the credits and even the deductions that we'll be talking about today, but you do file it right on your 1040. And so those are the types of receipts you want to make sure you keep throughout the year in order to be able to add them up and put them on your tax return when you file this April.
And how about the Earned Income Tax Credit? How do we utilize it? How does it help?
The Earned Income Tax Credit is another fantastic one. This is something that you want to make sure that you're taking advantage of, and it might be new for some individuals. There are many changes that have occurred over the last few years with the CARES Act and other credits and deductions that have become available over the years. So definitely be sure you check that one out as well.
And if you're adopting a child here, Emily, the cost of adopting a child, that can also be mitigated through tax credits. How so and how much?
Definitely. So this is really exciting for those who are on the journey of adopting a new child. This is a credit available to you. You have the ability to deduct up to $14,890 in expenses related to that adoption, including things like attorney's fees, court filing fees, and even expenses related to meals and travel expenses. If the child that you're adopting has special needs, you can claim that entire amount so long as your federal tax liability doesn't exceed the credit available to you. It does phase out over income levels, and so you'll just want to make sure you keep on top of that as well.
All right, Emily Irwin of Wells Fargo, thanks so much. Well, coming up, Creed 3 delivering a haymaker at the box office this past weekend. We'll tell you how much it made next. Increasing for the second month in a row in February, the index falling to a 3-month low on worries over a possible recession.
A decline entirely driven by expectations for the future. That means U.S. consumers keep feeling better about today and worse about tomorrow. We've got to talk about retailers, too. They're remaining cautious as inflation weighs on consumers.
We're just seeing a consumer that's making choices as they've seen the persistent inflation in a category like food and beverage, and that's taking a bigger piece of their share of wallet, and that's factoring into their purchase decisions.
I was at Costco this weekend, and let me tell you, those lines were incredible. As the consumer continues to gravitate and stick to those where value is everything for the consumer right now, they're looking for any way to save a penny.
Disinflation, like the Fed is out there talking about, is not necessarily happening. These companies are still dealing with high levels of inflation in their supply chain, and their customer base still dealing with high levels of inflation.
It's also a very bad macroeconomic situation right now where the consumers have shifted their spending. They're moving away from discretionary and sticking to staples. As a result, it's not the best scenario for the department stores in 2023.
I think the premium, the wealthier consumers are still doing well, and they're still pricing up, so to speak. Whereas the middle income and lower income consumers are not only scaling back some of their purchasing, but some of the features, some of the add-ons, some of the more premium components of leisure spend are beginning to tail off.
A new study shows that more women are quitting their jobs than ever before, and they're doing so in search of better cultures and more manageable workloads. Yahoo Finance contributor and co-host of the Brown Ambition podcast, Mandy Woodruff Santos, joins us now with more on this exodus. Mandy, nice to see you. So are they really quitting looking for just a better culture?
Yeah, I mean, I really feel like there's no going back to being a woman in the workplace pre-2020. Like women in the workplace today, we expect more. We've seen what the other side looks like with remote work, hybrid working privileges, not feeling like we have to hide who we are as working parents, and actually get what we need from our employers. So with the Great Resignation, and as we continue to have, yes, I know, a challenging, but still pretty positive, it's kind of weird job market, more women are still feeling like, I'm going to get out of here. I'm going to save myself. And I fully support this.
So, Mandy, if you're one of those people, you're trying to figure out what to do, the best option for you going forward, what should you do?
Well, first thing is first, if you're lucky enough to be able to escape, whether it's a toxic work environment or an environment, one of the biggest complaints for women in leadership roles especially is I'm not actually getting tapped for any opportunities to advance. And so sometimes you have to get out and move on for your own development. However, if a new opportunity has not fallen into your lap or you're not succeeding in the interview process, you may need to just make your situation where you are now a lot better. My biggest tip here is to not expect your manager to have all the answers for you. And I'm speaking from experience, okay? I remember walking into my manager's office when I was a senior director managing a team of 30 and just being like, I don't think I can do this. I'm so overwhelmed. And, he sort of looked at me and gave me a gift. He said, tell me what you need. And honestly, I think if we all were a lot better about advocating for ourselves, coming to the table with what we think are solutions, why are we feeling overworked, and how we can come up with solutions so that we can spread ourselves a little less thin, that would go so far into helping us feeling more burnt out. Your manager may be willing to help you, but they're so overwhelmed, they can't think of solutions for what you're dealing with. So bring those solutions to them.
Very important advice there and tips. You can check out Mandy's column at yahoofinance.com. Mandy Woodrow-Santos, thanks so much. Well, Creed 3 delivering a knockout box office opener this past weekend, even without Sylvester Stallone. Yahoo Finance's Alexandra Canal joining us now with a breakdown of these impressive numbers, and also turns out it's a huge win for Amazon too.
Yeah, because if you remember, back in May 2021, Amazon purchased MGM Studios for $8.5 billion. At the time, there was a lot of speculation about the strategy play there. A lot of industry watchers thinking, okay, Amazon is going to take those MGM Studio films, use that to help bolster subscribers, add more content to Amazon Prime Video. But we see them leaning into a much different strategy than some of their competitors like Netflix, which has held their films very close to the heart with all of those streaming exclusives. But for Creed 3, it's clear that the payout here is well worth it. We're seeing that the domestic box office, 58.6 million, over 100 million worldwide, the best opening ever for Amazon, best opening ever for the Rocky franchise. Those numbers mean the film is well on its way to a sizable profit. And there were a few strategic moves like marketing to younger consumers, really harnessing the power of Amazon.com and the synergies within that ecosystem to make this film a success. Also, the release date. This was supposed to originally debut around Thanksgiving, but that was changed due to the fact that Black Panther Wakanda Forever debuted recently around that time. So that was a smart move there. And really just the marketing, the trailers, everything just worked so well. And the lightning rod here, it all sort of goes back to Amazon and the sheer marketing power that it has within the tech world and really pop culture as a whole.
Yeah, this one looks really good. What a successful franchise. Did not necessarily see this longevity coming. We also didn't see this March boost in the box office. Will it continue though?
You know what? It will. And we've seen this lull in the box office. And that was one of the critiques heading into 2023, right? If the movies are there, people will come. If they're not, you're going to struggle to get those box office receipts. But we see a really strong slate in March. We have Scream 6, March 10th. I'm very excited about that. Shazam, Fury of the Gods. This is a big one, especially for Warner Brothers Discovery. That's revamping the DC universe. John Wick, Chapter 4, Dungeons and Dragons. I mean, really all potential blockbusters here pretty much every weekend in March. And the key story is this is all franchise, right? These are all franchises that you're seeing in the box office. You're seeing that in streaming companies. Paramount CEO Bob Bakish, Warner Brothers Discovery CEO David Zaslav, they've all preached this message of leaning in on franchises. And that's because we're in this risky macro environment. Yeah. So because of that, less risk is the sequel.
Or is it because there's no originality whatsoever in Hollywood?
That's been an issue, you know?
That's what I'm seeing on that screen.
That's what sells, right? I mean, it's this less risky option. You have that built-in audience. You know people are interested. I'm not disagreeing with you because I do think we need some fresher content. But I guess you could argue that that's being more experimented on the streaming side, but the box office, especially post-COVID, they want to rely on the big guys that are going to bring in a lot of money.
The movie Air, based on the Nike, Michael Jordan, that's original, and that comes out next month.
Also an Amazon MGM play there too.
Arguably the biggest media story of the weekend was Chris Rock, live on Netflix over the weekend, answering the slap from Will Smith. I don't know. I know we won't find out the numbers until tomorrow, but largely, what were the headlines, Allie?
I think everyone talked about this slap, especially on Twitter. People have been waiting for this. It was a year in the making. So that was what I saw trending on Twitter. You know, it was interesting. We talked to Michael Patcher on the show on Friday, and he said ultimately this isn't going to move the needle for Netflix, but you get the publicity around it, you get the press talking about it, you get people engaged on Twitter. It's just another option. And all these streaming giants, they're really looking at different ways of programming. So that's why you're seeing, you know, Amazon included, along with Google's YouTube, lean into live sports. We'll see if Netflix gets into that. There have been some cautious sentiment on the street that Netflix can't afford the sports rights due to how expensive that is right now. But you know, everything's on the table. There's a lot of competition. Profitability is number one. So you can't say that nothing will happen because everything is a possibility right now.
Yeah, their sports play has been really smart. Not paying billions of dollars for money losers, but targeted documentary type series that have gotten a lot of buzz and done very well.
Exactly.
Allie, thank you. And by the way, Chris Rock came out swinging.
Oh yeah,
He
did not hold back.
But he came out swinging at Will Smith's marriage. Check it out on Netflix. Allie, thank you. Quick programming note now. Be sure to tune in at 3 p.m. Eastern Time tomorrow to see our interview with IMAX CEO Richard Gelfond on the state of the movie industry and what comes ahead. And if we've got more than sequels ahead, right, Allie? Hopefully Richard's going to tell us about some originality coming our way. Okay, what's moving after hours? Shauna.
All right, Dave, we got two stocks for you here at WW International and Nutanix. Kicking off with WW International, better known as Weight Watchers. We're looking at a pop of just about 6% here. A lot of that has to do with a new deal from the company. They're buying a company called Sequence. If you're not familiar with it, this is what some are framing as WW Weight Watchers move here into the Ozempic market. So Sequence is a digital healthcare company, offers telehealth visits with doctors who can prescribe weight loss drugs similar to Ozempic. It's a diabetes drug that is used also for weight loss. That's a big reason why we're looking at gains of just about 6% here in extended trading. In terms of its most recent quarter, those numbers leaving a lot to be desired. Wider than expected loss of revenue missing estimates off 19% year over year. Subscribers totaling 3.5 million. That's a decline of nearly 8% quarter over quarter. So I think some of the hype around the deal to buy Sequence, that's why we're seeing shares move to the upside. Over the last 3 months, stock essentially flat, off just about 2%. Over the last year, though, under tremendous amount of pressure, losing just about 57%. Take a look at Nutanix. That stock off just about 3.5% here after hours. The big here, the company delaying its 10Q filing, saying that they are looking into a matter involving their evaluation software from a third-party provider that is going to prevent them from filing their 10Q on time. That's putting pressure on the stock here after hours. In terms of its most recent results, they did issue prelim second quarter results that did come in, revenue did come in higher than expected. They also updated their full year guidance. And when it comes to that, they raised their full year revenue forecast, which also beat the street's expectations. So maybe keeping some of those after hours losses in check, off just about nearly 4%. Over the last year, though, Nutanix is in the green, up just about 15%. All right, well, coming up, a new norm for workers with layoffs mounting. Employees are working harder than ever, especially on the weekends. We've got more on that when we come back.
Did you wake up this morning feeling refreshed from the weekend off, ready to dive back in and conquer the work week ahead? Or are you part of a growing number of Americans working weekends, answering emails at your sons and daughters' games and recitals? It seems remote work has forever blurred the work week lines and really broken the barrier that used to come with Friday happy hour. The average hours worked on Saturday and Sunday increased 5% to 6.6 hours, according to ActiveTrack, which analyzed more than 130,000 workers. Two industry highlights here. Computer hardware companies saw some of the biggest increases in weekend work. The average total hours increased more than 30% to over 11 hours. And media industry companies, we know about this one, increasing weekend hours worked 53%, over 10 hours. These industries recorded more weekend work than any other. Said ActiveTrack's vice president, quote, as people become more comfortable with flexibility, it's acceptable to log off at 3 p.m. on Friday and deal with work on the weekend. This, however, is a super slippery slope, one I don't recommend you go down. Key caveat here, I pester all my fellow employees with weekend emails on a consistent basis. But I have problems. I don't wish them upon any of you. Glassdoor data shows burnout is up 40% since pre-pandemic, and weekend work will only pour gasoline on the burnout fire. The UK, on the other hand, just showed tremendous results from the opposite, a 4-day work week in where essentially no drop in productivity and an increase in mental health. The conclusion here is don't be me. That's what I'm trying to tell you all, Shauna.
You don't have to tell me twice.
I think people need to lay off the computer, the iPhone, all of it on the weekend, refresh so you're not burned out, because it is an overwhelming trend in our country right now. People are burned out, they're stressed out, they've got really bad mental health. I know you're looking at me because I'm literally the poster child of it.
What are you going to do then with all your time? That you're going to have a lot more hours on the weekend.
No one asks me to work here. I just, again, have an addiction to it. So
work too hard.
Personal problem.
Yeah, I think more and more people are working on the weekends. Obviously, the study points exactly to that. I think it's very hard to draw that line, whether or not you're working remotely, even if you are in the office 5 days a week. I think our phone, the fact that we are always accessible, makes it very hard to totally detach from work. I think most people I know in my personal life do work on the weekends. I view it as a way to get ahead for the week. I view it so you're not as stressed on Monday morning if you take some time, especially on Sunday morning or Sunday afternoon, to set yourself up for the week. I personally think that my mental health benefits from that, but it's important not to go overboard.
That is a very interesting revelation. So you take what? 30 minutes?
No, yeah, or you could read up. I mean, it depends. It honestly varies, whatever you need to do.
But it helps your mental health.
My mental
because
health.
Otherwise you'd wake up Monday morning and it would come like a flood at you.
And I'd be,
that is tremendous. Because I really am concerned about mental health in the workplace. That is something I talk about often. And maybe that is I did not ever think about it that way.
I think it sets me up to be a little bit more calmer on Monday morning. You're not running around, the wheels aren't spinning constantly, or at least as much maybe as they potentially would be. Real quick though, two of the big reasons why people are doing this. It's because the Zooms and constant Slacks, it's hard to get away from those. They take up a lot of the time during the work week. And then also, not only that, it also has to do with the fact that you're constantly interrupted. That could cost you, $100 million per year in terms of companies that are lost in productivity because of the fact that people are constantly on their phones. And then the other thing is that job cuts. You're responsible for more. You're doing more in your day-to-day.
We should have had a poll, a Yahoo Finance poll, asking how many of you work weekends. We'll have to do that after the fact.
I bet more people than you think do.
I'm really interested to find out.
All right. Well, it is closing time here at Yahoo Finance. Let's take a look at some of the biggest stories of the day. Tesla cutting prices on two of its most expensive models here in the U.S. The cuts ranging from 4% on the performance version of the Model S to 9% on the Model X. These price cuts are targeting a more luxury buyer. To put it in context, last quarter, Tesla delivered around 17,000 units of the Model S and X globally, whereas it delivered nearly 420,000 of the lower-priced Model 3 and Y vehicles in the same time period.
JetBlue is expecting the U.S. will move to block its proposed $3.8 billion merger with Spirit Airlines. JetBlue's CEO saying in an interview with the Wall Street Journal that there is a high likelihood that the Justice Department will sue the company this week to stop the deal. The airlines argue that combining the two companies will help them better compete with bigger airlines and ultimately better serve customers.
And turning to tomorrow, all eyes are going to be on Capitol Hill for Federal Reserve Chairman Jerome Powell. He will testify about the Fed's latest monetary policy report. Now, his appearance Tuesday tomorrow is before the Senate Banking Committee. And then on Wednesday, Powell will update the House Financial Services Committee. He will likely face a number of questions about the Fed's fight against inflation and the impact of rate hikes on the economy. Well, that'll do it for us today on Yahoo Finance Live. Thanks so much for hanging with us. We'll see you right back here again tomorrow afternoon, 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. Have a great night.